2025 is one of the biggest tax planning years we've seen in a while. Whether you're a W-2 earner, a homeowner, or just somebody who wants to reduce their tax liabilities legally, there are some steps we need to take before December 31st in order to get that done. Now, if you're a business owner, I did make a separate video that goes over year-end strategies specifically for businesses in order to lower their liability. Hey guys, I'm Anthony Fontana. I'm with EA Tax Resolutions, and what we do here is we help individuals and businesses lower their tax liability through smart, proactive planning. Today, I'm going to be going over year-end tax strategies that individuals need to take specifically for 2025 in order to lower their liability. I'm also going to be going over the One Big Beautiful Bill Act as it pertains to the overtime deduction, the vehicle interest deduction, and the new SALT tax deductions. Let's do it. The first strategy is the easiest, most obvious, I think. Maximize your retirement contributions. Now, whatever you're contributing, it has to be done by December 31st, and the maximum we can put into a 401k is $23,500. Now, if you are older, there are some additional catch-up limits here. If you are between 50 and 59 or over 64, then the max you can put is $31,000. And if you are between 60 and 63, this is a new rule with the One Big Beautiful Bill Act, you can contribute up to $34,750. Now, this can mean a lot, bottom line, on your tax return to make sure that you do maximize your retirement account before December 31st. Just keep in mind your total contributions cannot exceed your total compensation from that employer. Number two is max out your HSA. If you have one of these high deductible health insurance care plans, the HSA is the most powerful tax tool in the entire code. The contribution limits for 2025 are $4,150 if you're an individual, $8,300 if you're a family, and there's a $1,000 catch-up if you're age 55 or older. It's a triple tax advantage here. Tax-free going in, tax-free growth, and tax-free withdrawals. Number three is spend down your FSA or your flexible spending account. These are a use it or lose it account. You may already know it, but this is a reminder. If you don't use all of your FSA account by the end of the year, it's goodbye. Strategy number four is tax loss harvesting. Now, if you don't know what this is, it's essentially selling your investment like your stocks that are currently down. That loss will then offset either gains you've had previously in the tax year, or if you have more losses than you do gains, you can offset up to $3,000 of your ordinary income on the tax return, i.e. you got a W-2, you can write off up to $3,000 on your stock losses. Now, obviously, this can lower your tax liability. Something you do need to note here, though, is you don't want to go ahead and buy back that stock that you just sold for a loss within 30 days. There's something called a wash loss rule. And if you go ahead and do buy back within 30 days, it will negate this whole strategy. All right, so number five is the clean energy tax credits that you can get for home improvements. Obviously, only applies to homeowners, but you can get a 30% tax credit on solar panels or battery storage that you installed in 25. There are other ones that we can get as well, which include exterior doors, energy-efficient windows, energy-efficient HVAC systems, or even insulation that you're putting in your home. Now, all these tax credits are set to expire December 31st of 25. So if you're thinking about getting this done, now's the time to move. All right, number six has to do with the overtime deduction. With the new tax law, you are now allowed to deduct the premium portion of your overtime pay. Normally, you get paid time and a half to work overtime. Now, that half is what is now non-taxable. So you're going to want to make sure you do get ready for the tax season when you go to file your return so you can get that deduction, because it's not going to be automatic. You're going to actually have to put it on the tax return. Now, we don't know yet, but payroll is supposed to give you some type of summary to let you know what that amount is. But if they don't, right, we'll have to calculate it using your last pay stub of the year and get that year-to-date amount of that overtime pay to be able to get that premium or that half amount that is tax deductible. All right, number seven has to do with the auto loan interest deduction. So if you bought a brand new car in 2025 and it is finance, that interest that you paid in 2025 is a tax deduction. So you're going to want to make sure that you do get that last monthly loan statement to show that year-to-date amount of interest that you paid in 2025. So when you file your 2025 tax returns, you get that as a deduction and pay less tax. All right, so number 8 has to do with itemized deductions. These are generally for homeowners that have mortgages. They itemize versus taking the standard deduction. And the new tax law allows for $40,000 of property taxes and income taxes versus the old law last year, which was $10,000. So it's a big $30,000 bump up here. And the planning strategy here could potentially be that you prepay property taxes this year if you're thinking that your income in 25 is going to be more than in 2026. Number 9 has to do with Roth conversions. This is if we have a 401k or a traditional IRA and we want to put it into an after-tax account and have it grow tax-free. Now, what happens when you do that, you get hit with tax in the year that you convert some of this. However, if you are not making so much money in 2025, it may make sense year-end to do this conversion before maybe next year or the year after you start making some money, so then you can have this retirement money grow tax-free for you. All right, so number 10 has to do with reviewing your withholdings of taxes, right? Take a look at your pay stubs. Have you paid enough taxes this year to avoid what we call the prepay tax penalties, right? The IRS will penalize you if you didn't pay enough taxes throughout the year. There is little thresholds that they have. Essentially, you have to either pay 90% of your current year taxes on your paychecks or 100% of last year's taxes, or 110% if you made over $150,000. So if you at least hit any of those thresholds, you don't have any penalty. But if you don't, then you're going to get hit with a penalty. We still have some time to correct for this. And if you're not there, then maybe we tell payroll, hey, let's bump up my withholdings so that I can meet that threshold and not get hit with a penalty. Well, I hope the video was helpful for you guys. If it was, do the usual, like, share, subscribe for myself. It really helps me out. And if you want your taxes done by myself or a tax planning strategy done by myself for you, please use the link in the description below to schedule that out. Thank you so much.